All right, folks. So we just heard from Chair Powell. And, my initial take here is he seems a little bit less certain, a little bit less confident, maybe a little bit confused. And I think that was kind of an interesting change for a man who usually comes out and seems to have a bit of a stride. There was only a few pressers where he didn't, right? February of 2023, before we had that sort of mini banking crisis, was one such press conference where he seemed a bit shaken, but he also was recovering from COVID at the time. So, that maybe that was wearing on him. But, this time around, he seemed like he was in overall good spirits and good health, but just really having trouble selling the 50. And that is that's something I think the market may sniff out as well, because there isn't a whole lot here to hang one's hat on to say, okay, well, opening up the floodgates with a 50 bips cut, pricing in 100 bips of cuts in total for 2024, half of which have been done, another 100 next year, another 100 in 2026, 300 bips of cuts, getting us down to about 2.5%. That's not exactly what I think a lot of folks thought they were going to see coming into this meeting. Obviously Fed funds futures were sort of front running this, but they've done that before. So it wasn't too much of a stretch to say maybe they were getting a little ahead of themselves again. Nevertheless, this is a Fed that's coming out and saying labor is much, much more of a concern here than what they're seeing in inflation, and full well acknowledging that the Fed can't really do much about housing. Now, why is that interesting? Because Powell, I believe it was in 2022, said to expect a reset in the housing market, due in no small part because of monetary policy tightening. Now we're saying, well, it's not our problem, it's the government's problem. They've got to figure it out, which is, a kind of strange thing to say, because the Fed is really the setter of rates. If they bring rates down commensurate with, where people feel comfortable taking on mortgages again, and the labor market doesn't weaken, we could actually see housing prices move higher. The real impetus for housing prices moving lower would more than likely be the labor market weakening and more supply coming on market than there is demand. But if we don't see a bigger weakening in the labor market, then housing prices could still remain high. Another thing he said that I found just a little bit odd was, that eventually we'll just be looking at inflation in the rear view and not even thinking or talking about it. And it's all about the rate of change. And, for everyone that pays bills, it's all about cumulative inflation, and it's all about if your wages are catching up. And wages have not caught up, and cumulative inflation is arguably very high for many households. So I think it'll still be a topic around the dining room table for some time to come. So I'm joined here by Ayesha. Ayesha also took in the press conference. We're going to discuss a little bit about what our thoughts are here. So Ayesha, you just wrapped up taking some notes, watching Powell's presser. I just heard John Farrow on Bloomberg say it was 15 minutes longer than what it should have been. What were your thoughts of the press conference?
I have to say I'm a little bit puzzled as to what he said. I mean, clearly, Chair Powell was off his game today. I'm not sure if it's because he's nervous about, where things are going, or whether, he was unsure about the 50 basis point cut that, the committee just made. But it didn't seem like he was very sure about answering many of the questions. And while he did try to downplay the risks ahead, just as we expected going into the meeting. And he talked about, the labor market being okay and them trying to preempt any deterioration or trying to get ahead of things here. He also very emphatically said that they don't think that they're playing catch up. They're not behind the curve. What they're trying to do is sort of engineer a soft landing maybe, and make sure that a recession is avoided and try to get things or keep things in place before the labor market deteriorates further.
And it's an interesting sort of more preemptive approach than maybe what we're used to from the Fed. I mean, going back we look at policy that seems like it's more reflexive. Something breaks, the Fed comes in, there's a large series of sort of stick saves in the form of rate cuts, eventually some QE, and then, the economy starts to get stimulated and turns about. It seems like Powell today is trying to say, you know what, this time around, we're going to try to get ahead of that outcome. And instead of being reflexive, we're going to be preemptive.
That's right. So it seems he's suggesting that this time is different. We know that the Fed is famous for making policy mistakes. We know that they're famous for being late to every party. Even when they started hiking, I think everybody will agree that they started hiking a bit too late. And that's probably one of the many reasons that inflation got to where it was. And it took such a long time for it to come down. And they had to hike so aggressively. I mean, had they sort of nipped it in the bud, things may have turned out differently. However, this time around, he seems to suggest that they're not making that mistake. They're not delaying their cuts, and they're going to be quite aggressive about it. But when they were asked whether they would have cut in July, he actually said that yes, had he seen the labor report, they would have probably cut in July as well. And so, on the one hand, he's saying that they're not playing catch up, but on the other hand, he's kind of insinuating that they are playing catch up.
That's a really, really good way of putting it. And I think that that's exactly what it sort of felt like watching this meeting, that they were trying to defend their record, but at the same time sort of admitting we got it wrong. And we know that the Fed probably has more near-time indicators of the economy's health than probably any other financial institution on earth, with more economists tuned into that and presenting their findings to the board. So it's kind of hard to stomach the idea that they didn't have some idea here that the labor market was weakening more over the summer. Certainly, we've seen it in the Challenger data. There was a large set of firings across tech. We've seen it in ADP data, in tech, and what they call, I think, information, as well as professional services and small businesses. They're really areas that have shown weakness. But on the other side of it, Ayesha, one of the things that you've talked about, and we've had back and forth conversations about, is that labor market conditions seem more like they're normalizing than deteriorating, that there isn't really this path to imminent recession and a bunch of red flags and sirens going off. It feels more like we're going to pre-COVID conditions of 2018 and 2019 in a lot of these metrics.
So yes, there was a lot of overhiring and a lot of imbalances, to quote Fed Chair Powell. There was a lot of imbalances, and we've been tracking that, right? And we saw various pockets of the market where people were just not coming back to work, and so it was very, very difficult for people to, hire. And so, in many circumstances, there were more, I want to say, job ads put out. There were more people trying to hire. Some people were sitting at home because of the wealth effect. Some people because of COVID, various reasons. So supply was kind of limited, and the fiscal impulse also helped. People actually got paid to sit at home in one sense, right? Like they were okay sitting at home without a salary. On the other hand, you had, businesses opening up, but not being able to get these workers. So there was this tightness in the labor market because of that imbalance of supply and demand. And you can see that in the JOLTS data, right? So you can see that job openings were like massively higher than pre-pandemic levels. And now we are normalizing back to pre-pandemic levels. And so that kind of suggests that the market is in better balance. However, we haven't fallen like significantly lower than where, we were pre-pandemic. We're still higher than pre-pandemic levels. And then you have the unemployment rate itself. So 4.4% or 4.2% as we are right now, and the projection for the Fed is 4.4%, is not an exorbitantly high unemployment rate. And I think, Chair Powell said that as well, that it's more close to full employment than it is to a dire situation. So, all things considered, there are measures of the labor market that suggest that things are not deteriorating massively. But on the other hand, there are, again, pockets of the market that have deteriorated faster than others. And something I think that you pointed out was because many of these job cuts are now in professional services and in tech, um, these were the spenders, right? And so that could sort of hurt the economy. But what I find interesting is they suggest that the unemployment rate will go up to 4.4%, which again is not a huge move upwards, yet they're cutting aggressively. They also project a 2% GDP growth rate, which is um, very strong
Yeah, for a mature
comparatively.
economy, yeah.
Yes. The UK is at 0%. The Germany is negative. The EU or the Euro area is at, I think I want to say 0.3 or something. But everyone's below 1%. And so comparatively, the US is doing very well. So with everything being kind of okay, I'm still trying to understand why they're being so aggressive in terms of rate cuts.
So one of the members of the chat was speaking to what if this has to do with the financing cost of the government, where we see interest now exceeding $1 trillion a year. Obviously, Powell can't speak to that directly because the Fed's official stance is they don't monetize the debt. It's outside of their policy framework. But do you think that entered into the calculus of the Fed's decision, both in terms of the cut today and then the expectation that we're essentially going to have 300 bips of cuts total or 250 bips more by the end of 2026?
So that's an excellent point, actually. And I think that could be very well be a very good reason for them to cut this aggressively. So the one thing is we've been seeing the US Treasury. So one is the interest rate going higher, of course. But also we've seen issuances, right? So Treasury issuances have largely been at the shorter end because the curve has been inverted, and obviously you're getting paid more for shorter end maturities than the longer end. And that's not how it's supposed to be. That's not normal, right? And then in many circumstances, I think you would not have a huge amount of demand for the long end if you were not getting that premium, so to speak. And so this is actually a very good point that one of the reasons could be, see, they've also increased the terminal rate a little bit. I know it's a very small increase from 2.8 to 2.9%, and this could very well go higher in the next few meetings as well. And they probably don't want to spook the market into saying that the terminal rate is readily going to be like 3% or 3.1%. But even that 0.1% change actually makes a big change to your longer end rates. And so that is the kind of premium that will be baked into the long end rates and will probably attract more demand and will help the Treasury sort of balance out their issuances a little bit more and create some duration in their issuances.
So here's a funny question, but it's not really that funny at all. Did Janet Yellen win the game of four-dimensional chess? Because it feels like with that fiscal dominance that the government put through, as well as maybe some of the preferences of where to issue treasuries, when to issue debt, the first half of 2023 largely being a period of no debt issuance, able to neutralize the impact of QT, and then fiscal dominance going more and more into that. And now she's forced the hand of the Fed, potentially, based on what we're talking about here, with the cost of financing going so much higher, that now they have to come back and cut pretty much all of the hiking that they did away, in no small part due to the most aggressive deficit spend as a percentage of GDP with unemployment this low ever. Is she able to say checkmate versus Powell now?
I hate to think that's true, but it very well might be.
That's absolutely bonkers.
It is. But see, to summarize my takeaway from today's meeting, I think I'm quite See, I'm at a loss for words as well, but I feel like even Powell was at a loss for words. I don't feel like he was fully convinced about what he was saying. Now, without reading too much into it, I don't know what's driving this, and there seems to be a lot more um, that's happening that he's not talking about.
Yes, that is the impression, that there was more that wasn't said than what was said. And I think that's the best way to kind of recap the meeting from a big picture scenario, that it felt like there was just a lot of unspoken kind of angst in that room. And there were a lot of things that he said just before you came on the stream. There were two observations that I had, and I wanted to share them with you because I thought they were a little odd. In 2022, I believe it was over the summer, maybe it was later in the year, he spoke to the first time I've ever heard a Fed chair say there's a housing bubble. He also went on to say, expect a reset, that it was one of the prerogatives that they wanted to see a reset in housing prices to help to reduce wealth effects. In this meeting, a journalist, I think it was from the New York Times, asked him, well, what about the housing market? Inflation seems to be sticky there. And, does that really let you cut as aggressively as what you seem to be planning to do? And what he basically did was shrug his shoulders and say, well, it's the government's problem now. That was a pretty big departure.
Yes.
The other thing I found very curious was his take on inflation. He basically was saying, well, as long as we get back to this sort of steady rate of price appreciation that isn't too dramatic, that inflation will be in the rear view and most people will just forget about it and won't even be a word we talk about anymore. And once again, I've got to pound the table on the difference between the rate of change and cumulative inflation. Because wages haven't risen commensurate with the rate of change, nor have they caught up with cumulative inflation. So I feel like around the dinner table in American households, and really in many parts of the world, inflation, that I word, is going to be still a big part of the conversation. It's going to be part of how people make spending decisions. It's going to compress the familial budget, cause people to take on more debt. And while 50 bips seems like a lot, if you're paying 25% APR on your credit card and it just went out down to 24.5%, your wages are the same and your prices are continuing to go higher, albeit at a smaller rate, I don't know that inflation's no longer a topic people are going to talk about. What do you think?
I don't think so either. I think they're trying to, again, downplay inflation here. It's when asked about, the shelter inflation, and I'm glad they asked about that because that's really something that I wanted to hear about. He kind of downplayed that as well, explaining what's going on. But the point is, we don't need an explanation. We know what's going on, right? The question is, does it worry them and what's next? Right now, the way things are going, rates either need to be much, much lower for, the mortgage market to start up again, for people to move, to cancel their mortgages and move to lower rated mortgages or similar rate mortgages, let's say. And we're not going back to those levels again. That's very normal. So if that's the situation, then there will be a large chunk of the market who will actually never cancel their mortgage. They will stay where they are, right? They'll be happy to stay where they are. Why would they want to pay more? Unless there's a specific need, right? And even if there is that need, just hear me out. If I had a home, and if I had a smaller home, and I want to now move to a bigger home, but I don't want to break my mortgage because I'm paying a very low mortgage, I'd probably rent my home, keep my home, and rent this home because rentals are so much higher right now. And I'd get a good rental, amount for it anyway. And so why would I break that mortgage and sell the home? Because the rental will more than cover the mortgage payment, right? And then I'd probably go somewhere else and get either another house or do something, or rent somewhere else. So I know it doesn't always make financial sense, but letting go of an asset where you're paying such a low mortgage rate is a very, very, very difficult decision. And I don't think many will make that decision. And so no matter how much they cut rates over here, I think there will still be a huge chunk of the market that is priced out.
Yeah, I agree. I think the only way you get back to those historically low zero interest rate era mortgage rates of 2.5, 3.5% is if something really bad happens. And in that situation, most people won't be looking for a mortgage or a refinance. They'll be more concerned about their financial security because it suggests unemployment has spiked, the bottom has dropped out of the market, and everything's kind of going haywire. The interesting thing about the housing situation is, as you pointed out, a lot of people don't want to move because they've locked in these really low rates, 2.5, 3%. Lots of households, really the bulk of mortgages right now are locked in around those rates. And so the only way that you really get existing supply higher and demand lower at the same time, sadly, is a slowing economy, a much slower
Yeah.
economy, a higher amount of unemployment, more people. And again, I hate to say it because I don't want to see it happen. But the reality is more people need to be out of work such that they're forced to sell their home, such that those homes come on the market in excess of where there is demand so that prices can move lower, so that all that existing supply starts to unlock. And it sounds like with what Powell said today, he's saying that's not our problem. Meanwhile, one of the presidential candidates is talking about a $25,000 first-time homebuyer stimulus, which is certainly not going to reduce demand. Even if supply comes up, even if the economy softens a bit, that $25,000 is a pretty big buffer. In some places, it's even more than your down payment would need to be. So it kind of gives you a sense that really up and away, for some parts of the inflation picture, including the critical part, shelter, is still a factor to be mindful of. That the shelter inflation picture, that concern, that part of the stickiness, is still something we need to pay attention.
I think so. It's still quite worrying here, and I'm not sure that inflation is completely conquered the way they say that it is.
Yeah, I mean, the initial reaction function to the dollar was dropping below key support. We've now kind of leveled off. We saw rates drop. We saw the dollar drop. We saw precious metals run. A lot of that move reversed here. It's kind of interesting how much the volatility in currencies and in rates has sort of reversed itself, right? So now the dollar is trading above that key support level of 100.5, trading at 100.55. We got the S&P 500 near the day's lows, looking like it's about to take them out to the downside, which is really interesting. You get 50 bips. You get everything that everyone wanted. And as you take the hedges off and you see real price discovery, people are selling. And underneath the surface today, we've seen enormous amounts of iceberg sellers. So if you're watching our bookmap stream throughout the afternoon trading session, you'd see well over 10,000 sell-side icebergs in spans of 30 minutes, which is unusual amounts of aggression by these passive sellers, these trading desks at institutions. And what that's telling you is as these SPX put-driven hedges are coming off, and we saw large flows into the 5,300 strike yesterday and large flows into the 5,500 strike today, as people are selling those puts and liquidity is coming back into the market. And in addition, as many of the puts that remain on the chain are losing value ahead of Friday's options expiration, adding more passive flows in that last hour of trading, there's still an excess of selling pressure above and beyond that, which is giving you a sense that at least initially, the reaction function often takes a matter of days, but initially, the market's not super thrilled with this turnabout by the Fed. That 50 bips may have some folks, and the demeanor of Powell during the press conference may have some folks just a little concerned about what are they missing, and as Ayesha said, what are they not telling us? So I think that's interesting. I feel like at this point, I know it's really late where you are, Ayesha. It's like 11:46 p.m., so I don't want to keep you on too much longer. But as we wrap up, and as we wrap up this trading day here, do you have any final thoughts that you want to share?
So as I think the market starts to, let's say, absorb what's happened, I think we're still going to see somewhat of that rotation. 100 basis points of cuts for 2024 suggests that the market or the economy is weaker than we're seeing on the surface, right? That's the basic thing everybody will take away from this at the end of the day. And so some of that rotation that we've been seeing into more defensive positioning, and when we say defensive, large caps, value, non-cyclical value, Those, I think, are still prevalent in terms of equity positioning. I think it's important to continue to look at the S&P equal weight versus the S&P itself, although the S&P did make an all-time high. I can see that small caps are rallying, and this is likely a reflexive bid, right? So small caps generally rally when the Fed starts to cut rates, but that's usually when there is a recession. We are not seeing a recession just yet, but perhaps small caps are telling us that there's something on the horizon. Either way, if you are inclined towards small cap, we would still like small cap value, as in companies that make money over companies that don't make money. I still think that there's a chance that the long end of the curve goes up, so we see a bear steepener, and that can sort of put pressure on TLT and long bonds. That would also put some pressure on risk assets, right? Like the riskier parts of the market, particularly small cap growth again. So it makes sense to sort of be a little careful over the next couple of weeks as the market adjusts to this new information and, assets get priced accordingly. So I do understand that a lot of people were thinking there might be 100 basis points of cuts, but maybe not all of that was priced in, right? So there will be, I want to say, firms and companies and banks and portfolios that are repricing a lot of these risks. And so it makes sense to be a little bit more cautious. Also, we're entering a difficult time in terms of seasonality and in terms of the election. October is always a month of very high volatility before an election. So we just need to be a little careful out there in terms of position sizing and taking on inordinate amounts of risk.
100% agree with absolutely everything you said. Our baseline calls have been looking for this defensive rotation. High dividend paying S&P large caps has been one of our long allocations versus the broader market cap weighted SPY or the high betas, the SPHB large caps. We like value versus growth at every size factor, large, medium, and small caps. We like looking at equal weight versus market cap weight in the S&P because we think it's finally time for the inglorious 493 to have their day in the sun. And in fact, these are trades we've had on for about 2 months now, and they've been working pretty well, these pair trades. And 100% want to reiterate what Ayesha said, that this is likely to be a more tumultuous period. That it's not necessarily a great time to take on huge amounts of risk or go back to the old familiar trades. Some of these things are likely shifting underneath the surface as we enter a new differentiated regime. So I think we need to be just a little bit more cautious about how much risk we want to take, how concentrated we want to be with that risk. I find in my own portfolio that I want to be more involved with a more diversified defensive approach. I favor the dividend payers. I favor the short end notes of treasuries. I'm looking at some of the emerging markets that are looking a little stronger, some of the ones that we cover at MacroVisor in particular, like India as potentially having continuation, like Philippines as potentially having continuation. And I would say for folks out there listening, wondering, what comes next, I'd say that we are in a period of greater uncertainty, not just us, but the entire market about what all comes next. We've never been here before. The monetary policy and fiscal policy framework that we've had over the last 4.5 years is unprecedented. We're in uncharted territory. You can see it in Powell's demeanor too. He doesn't know where he is. He doesn't know where we're going. He's doing his best to inspire confidence, but he's not confident. He's not projecting that, same sort of sense of surety that he's had in the past. So I want to just kind of say that this is an evolving situation that we will continue to cover. As time goes on, there will be more opportunities on both the long and short side of various markets. That's something that we continue to cover at both TraderAid and MacroVisor, so check us out. If you'd like to take a free trial of the TraderAid Discord, you can visit wap.com/TraderAid. You can get a free 3-day trial there. But at the end of the day, stay tuned as we cover this evolving situation, because easy mode is likely behind us to some extent. We're going into a more pronounced period of volatility and potentially more of a asset class and stock pickers market, both here in the US and globally. And that'll be fun. It'll be challenging. It'll be a good time for investors to sharpen their skills and traders to adapt to lower liquidity, higher volatility conditions. It's an exciting time, but it also means it's a time to be more careful about execution, risk-taking, and being kind of cognizant of those evolving conditions. So we want to thank you all for tuning in. We really appreciate it. We'll be back soon covering some of the next major events that are happening, really focusing more on the labor market now than in the inflation side. And if anyone has any questions about anything that we've talked about, let us know. We're always happy to help. This is all about helping you, the retail investor and trader, learn more about the macro, learn more about the markets and where they meet. We'll see you soon.